Let's talk about when we can call an end to this bear market so we can be prepared for when that happens. I'm going to define three criteria to determine the end of this bear market in stocks. The first is we want to see the major indexes in stage 2, which is the Dow, S&P 500, and the Nasdaq. We want to see the breadth of these indexes with 50% of stocks or more in stage 2. And that's important because we don't want to see just a few of the larger cap stocks moving the indexes higher and the rest of the market drifting sideways to lower. That's typically what happens late in a bull market when the market narrows and leadership starts to get concentrated in only a few stocks. That's what we saw last year with like the FANG stocks being some of the only stocks that were continuing to go higher. We want to see broad-based participation in the market if it's going to be in a healthy stage 2 bull market. And finally, we want to see leadership sectors breaking out of stage 1 bases where this is the growth part of the market that actually pushes it higher into a new bull market. The market can't sustain a long-term uptrend without new IPOs and high growth sectors coming out of the market and pushing the market higher and causing institutional money to flow into the market as earnings and sales growth go higher in these growth areas. Now, currently in the market, none of these cases that I just described are actually happening yet. So it's still not safe to wade back in, although obviously the price action has been good for the bulls the last month and a half. But we can see that the triple Q, the transports, the S&P 500, and the Dow are all still in stage 1, and the Russell 2000 and the microcaps are still in stage 4. So none of the major indexes are in stage 2 yet. The Dow is the closest. It's been in stage 1 for 3 weeks now, and it's actually almost getting close to retesting the highs from 2015. Now, breadth-wise, we have 60% of stocks in the Dow in stage 2 now, and about 45% of stocks in stage 2 in the S&P 500. So the Dow has already gone over 50%, but the S&P 500 is still kind of below that threshold. And it's notable that the Dow only has 30 stocks in it, and a lot of the stocks in the Dow are large cap, kind of cyclical or non-cyclical stocks that are defensive, like staples and telecom. So not surprised that the Dow has the largest percentage of stocks in stage 2, and the S&P 500 is the second largest index with large cap stocks, and you're seeing a higher percentage there versus the New York NYSE and the Nasdaq. NYSE only has 36% of stocks in stage 2, and the Nasdaq's been badly underperforming at 28% of stocks right now. So we can see that the indexes that have a lot more smaller cap stocks are lagging the indexes that are loaded with larger cap stocks. And that's a sign of a market that's still kind of defensive in nature. Talking about leadership sectors breaking out, we're still not seeing that happen yet either. On the watch list page, this page pulls in stocks that are breaking out into stage 2 on high volume. And if you look at the type of stocks that are coming into this list, they're still just not the type of high growth, new IPO type of companies in specific sectors that are actually moving into stage 2. You're still seeing a lot of gold stocks and just sprinkled amount of general stocks here and there, but no real trends in new industries breaking out. And the same thing is being observed on the markets page. If you look at the largest percentage of stocks in stage 2 per sector, you still see a lot of utilities and REITs, government bonds, precious metals are still kind of leading the market. Um, if you scroll down a little bit further, there some of the things like semiconductors and some technology areas are showing up, as well as some financials. But overall, still not seeing some of the bigger growth areas of the market breaking out into stage two. So it's still not a safe time to get into the market, and actually it is actually an extremely good risk reward situation for shorting the market right now. I've talked about in previous videos how anytime we're above the 30-week moving average in a bear market is where you want to enter on the short side. And now that the SPY has gotten all the way up to about 205, we can see that if we go up to 207 and a half and just up to 210, so 2.5 to 5 points higher than we are now brings us to new highs. So if you're looking at the short side, the risk reward is awesome right now because you can risk about 2.5 to 5 points if you're wrong to make potentially 10, 20, 30 points or more on the downside. And this is what happens when the market undergoes a bear market rally. If we're still in a bear market, it gets all the bears frustrated and out of the market and sets up a good shorting opportunity with high risk reward potential. And I've talked about in the past as well the percentage of stocks in the S&P 500 above the 50-day moving average. Whenever that goes above 75% is where you want to look at shorts, and we're sitting right at about 95% right now. So this is potentially, if this is still a bear market, this is probably the best risk reward potential entry that we could see in this entire bear market is going on right now, with where the S&P 500 is. And one other thing to look at is if you're thinking that this market's kind of been in a bear market for a long time, um, if you go back to like 2008 and other previous bear markets, it takes usually quite a while for a bear market to get started. In 2007 and 8, it took almost a year essentially for the market, when it finally made one of the latest lower highs before it finally topped, which was in like March 2007, all the way until May 2008. The S&P 500 was at the same level, and that's when it finally broke down into the meat of the bear market. So if you look at what's going on currently, we've been topping for just about a year. So kind of the same situation with kind of tighter price action than what happened in 2007 and 8, but still the same potential situation where a topping process leads into a stage 4 downtrend. So it's constructed for the bulls that we have made this positive move in the markets, but for the bull market to come back, we need to see those three things that I talked about happen again, and we're pretty close to some of them. So we have to switch back to bullish if we do transition into a stage 2. But until then, um, if we don't, this is a high quality entry right now if we're still in a bear market.